What do you do with your money so that it preserves its value and hopefully goes up in value over time? My name is Kevin Espiritu. My business is called Epic Gardening, but this is just my personal life and business channel where I talk about whatever I want. But the disclaimer I will make: first of all, you really shouldn't listen to me about almost anything I say unless it makes sense to you. But especially in this video, this is not investment advice. So this is just what I'm doing and my philosophy on it. And hopefully it is, inspiring or helpful in some way. So with that said, let's first discuss how do you kind of bucket and approach the money that's coming out of your job or your business. Now, if you have a business, generally speaking, what I try to do is put as much money back into that business as I can, because that's going to return you more on that dollar than almost anything else you could put it into. If you were to have a cupcake shop and you're making, I don't know what the margins there are, but like 15 or 20% on your money, well, that's going to beat almost any investment that you can make in almost any market right now. So you should probably put all the money there. Now, there is a natural limit on that. So you're going to have money that comes out from your salary or just extra cash at the end of the year, something like that. What do you do with that money? Well, what I do, so let's take Epic Gardening, right? So if I'm not investing into Epic Gardening, or I've invested enough into it, like buying inventory or investing in more people or whatever, then what do I do next? Well, you have a salary that comes out of your business. And so what I do is I'll take as much as I possibly can and I'll put that into a 401k that I have with Epic Gardening. So I'll put it into my 401k and I'll max that out. It's great to do that because that takes it off of my taxable income for that year. With my 401k, I'll pay the taxes when I withdraw it at retirement. And so it takes it off my taxable for this year. So I'm reducing my taxable income, right? Now, that's fantastic because that means that I pay less taxes now. I get to defer it until later, and I put that money into a vehicle that gets to grow over time. I'll talk about what's in that in a second. The next thing I do is I will then put money into a Roth IRA. After I do that, I have to pay taxes, right? So I have to pay taxes on my Roth IRA stuff before it goes into the Roth. And when it comes out of the Roth, it's tax-free. So it's almost the exact opposite of the 401k, but it's a much lower amount. It's about $6,000 you can put into your Roth, whereas your solo 401k, you can max out somewhere around $58,000-ish, I believe. And so that's a big decrease off of your taxable income. So that's one thing that I'll do. Two things, actually. So you really should be thinking about put as much as you possibly can into your tax deferred or tax advantaged accounts as possible. Now, what's actually in those accounts is a different question. So that depends on how old you are and what your risk tolerance is. So if I'm relatively young and I'm, 31 years away from the traditional retirement age of 65, though I don't really plan to retire ever, technically, or, well, that's another video story. We'll talk about that some other time. But I'm 31 years away. So I put in my Roth and in my 401k 100% equities, 100% risk on, because I don't really care about the fluctuations over the near term. And I'm talking even over 10 years, I don't care. I care about it over 30 years. And so I'm going to put it into some very equity heavy stuff, so Vanguard mutual funds, and it's going to be total international stock index, total US, small cap value, small cap growth, all that kind of stuff, because I don't really care what happens. I want the higher risk, the higher return over a longer period of time. Now, when I get older, I'll be shifting that more down towards some bonds and things like that and taking the risk off the table because I need to preserve my capital at that point in my life. Right now, I want to grow my capital. Later on, I'll preserve it. So that's what I do in those accounts. Now, what I do outside of those accounts when I'm trying to do more with my money instead of just letting it sit in a savings account. So what I do there is I basically just set up a traditional brokerage account with Vanguard, and I just almost replicate the exact same thing. It's a little bit less risky because I basically have two buckets. One bucket is money that I might need in 1 to 3 years for some sort of purchase. If I was to, buy a car or to buy a property or something like that, I'll put money into a 1 to 3 year. That's more capital preservation. It's more just making sure that I don't lose track of that money. So what's that in? That's in stuff like limited term tax exempt bonds, municipal bonds, things like that are just going to kind of keep pace. They're not going to do much. They're not going to lose to inflation though. They're just going to keep pace with inflation. Then I've got a 3 to 10 year bucket. So that's money that I'm not going to need for at least 3 years, ideally 5 to 10 years or so. And that's much more risky. I would say that's 80% stocks, 20% bonds at roughly the same sort of funds like Total International, Small Cap Growth, Small Cap Value, this sort of thing. Now, if you're not familiar with mutual funds and Vanguard, let's do two things right now. So I'll recommend reading Bogleheads. That's a good book for this. I'll put it in the description. And then also I recommend knowing your circles of competency, as it's called, in the world of sort of like the Warren Buffetts of the world. So you need to know what you're good at and what you're not good at. Chances are, if you're not working in the world of investing for a living, you really shouldn't be thinking that you're some sort of master trader or master investor in these sorts of markets. You really should be tripling down, quadrupling, 10xing down on the thing that's making you your money, right? So your career, if you, let's say you're a lawyer, triple down on being a lawyer, triple down on being a doctor or working at a company like a big tech company, wherever you work. Or if you're a business owner, triple down on your business, because that should be getting you the quickest return on your money. You can get raises, you can get more business, whatever. You really shouldn't, in my opinion, be spending a lot of time thinking about, oh, what should I be doing? Should I be buying American Airlines stock right now? Should I be doing this right now? It's not your circle of competency. Put your money to work for you in broad-based, really low expense ratio index funds for now, and just live your life. Just go back to what you were doing that got you enough money to put into those accounts. A lot of people that I know right now, especially after 2020, are doing stuff that I think it's unwise. I think it's very unwise, and I think your returns are going to be poor. And it's people who are basically thinking that they're now traders or they're now investors. Meanwhile, they do a job day to day. They're working for, a salary at a company or the government, and they don't have any contact with investing. Just over the last year, they think they can make 1% a day over the course of however many, months and years, and it'll compound into this much money. I'm like, look, you and everyone else thinks that. It's not going to happen for you. And even if it does, there's a risk of ruin over time that you're going to be spinning your wheels. Triple down on your career or your business, and then just put your money into these safer, sort of proven vehicles and just go along for the ride. I mean, that's what I do. I don't check my investment accounts more than once a month, maybe once every 2 weeks or so. Now, people are probably going to say, well, what about alternative investments like cryptocurrency or like, I don't know. There's all sorts of different ones, gold and silver and stuff like that. I'll be honest, I got into some of this stuff in the past. I think the first crypto I ever had was 2013. I got more in 2017, and I've been into gold and silver a little bit. Now, what I've learned is, number one, it shouldn't really be the bulk of your portfolio, in my personal opinion. I have friends actually that are almost 100% in cryptocurrency, and that's how they live, and they're very much believers in the technology. I respect it. It's not for me. But, for me, I keep something around like 5 to 10% of everything I have into cryptocurrency, because I do feel that the power and the technology behind it is extremely, extremely strong and probably will change society forever. I do feel that. So I'm making that bet, and I'm comfortable losing that 5 to 10%, 100% of it. If it was to go to nothing, I'd be like, I guess I was wrong, and that money would go away and I would write it off. Now, that's my personal risk tolerance for that. But in general, I would say, number one, put money back into your business or invest as much as you can to get raises and career improvements. That's going to be your best use of money. Number two, put it into tax advantaged or tax deferred accounts, into broad-based index funds that you don't have to worry about at a sort of allocation that you're comfortable with as far as your risk. And then number three, if you do want to play around with some of these fun investments, then just do it at a percentage of your portfolio that you're comfortable with. Because, man, some of these people I know that are doing this all the time, they're so stressed out, and then they have to go do their normal job or run their normal business. I'm like, guys, just relax and just, know what you're good at in life, and do not do the stuff that you're never going to be world class at. So that's it. Good luck, guys. I'll see you in the next video.